Right. There we go. As far as
orange, if it's orange or red, I think you're recording.
I see that little dot going here for everybody. And then how do I, one more question here. How do I see the everybody mugshot again? I seem to have lost my video with everybody else. That's okay. I don't need it. But,
ironically, I'm seeing them. I don't know. I see Uberto and you and Dave Z and me. I don't see John. I don't know what happened. Oh, I see. I got to expand it down. Okay, my fault.
Did I?
Angela, John. There we go. It only goes so far. I mean, unless you go full size or something. Let me go grid here. See what it's going to do. I don't know what it's doing. Some small active.
All right.
Video.
Well,
I've not played with that. Okay, that's my fault.
Okay.
Anyway, sorry.
Not a big deal. All right, guys, we're recording. Let's kick off this brief here, and thank you for the working with the audio delay so everybody can get on in a little bit smaller venue than we have with Jeremy leading on a daily basis, or Brad, or Latoya. Let me kick this off here. This is some quick music for you guys, and we're going to take a little trip.
1, 2, 3, 4. Come on, oh, baby, don't you want?
Oh, I see Ken. He just joined. All right. Welcome, Ken.
Hello, this is John Wheeler. I'm on my phone.
All right.
That works. We got you.
Welcome, guys. All right. There's a picture of the Chicago Board Options Exchange. As you guys know, I've shared with us a few folks. I've actually been to things years ago.
Fred, excuse me. I can't see all I'm seeing is the video of who's attending, and I get you on another screen, but I don't see.
Okay.
I don't see the CBO. I know it's in the background, but I can't get to it.
Okay, hang on just a second. What happened to my?
There we go.
What do you see, Mark?
It's on top now, but it's hiding behind you under the settings panel. Why the settings panel?
It's on top.
It's up, I'm not sure.
What is on top, Mark?
Well, right now the settings panel showing you is there, showing a Logitech HD Pro webcam C920. So that must be coming off of your machine. And then I have the Zoom attendees. Mm-hmm. Now it's CBO pit. No, it went, and now it's gone again.
Hang on. So why is that doing that?
I don't know. Hi, Justin.
Hi, guys.
All right, tell me what screen you're looking at here. What do you see?
Oh, check your share screen. Go to the share screen font. Okay, there we go. Now we got Thinkorswim.
Yep.
Okay, for some reason it switched monitors on me. That's okay. So there's Thinkorswim. I'm just going to run it off of this monitor then, so we can press. Let me pull up your slideshow, Mark. All right.
Dynamite. Sure.
It was over here. I'm sorry. It's under the Explorer icon. And guys, what we're going to do is Mark is going to give a briefing here on his expertise on how to conduct the long call diagonal trade setup. And confirm everybody can see Mark's brief now, the leap call diagonal.
I got it.
All right. That is fantastic. All right. All right, guys, I'm going to hand it over to Mark here. I'm going to sit and listen to him for a while. And then if this is open voice-wise because the group is small enough. So if you do have a question, please just stop and ask. And I will sit back and let Mark take it away. But I got to drive the slides basically from my screen here. So Mark, when you're ready, why don't you tell the group quick about yourself and then take it away.
Thank you, Fred. I'd be happy to. I have been trading more or less seriously since 2001, but more focused since 2011. And I know Jeremy Alexander Newsom from his previous life at Trade Smart U. That's where I encountered him and thought he was about the best trainer I'd ever come across in my life. So like so many people, I've blown up a couple of accounts thinking I could trade this stuff and not really understanding the things that they teach us now. Fred has been very kind in teaching me the leap call diagonal trade. And basically what I did was take my notes that I got by talking with him in a conference like this and put them down on paper so that we could share them and send them forward. So this is the cover page. You can see that the date and the revision number are there. The current one is 4.1. And as I change these, I changed the revision number so we know who's got the latest. And if you need one, I'm happy to send it out, or might eventually start periodically just posting it on Slack now that I think I understand how to do that. Anyway, this is the cover page. We're going to cover an overview and goal setting, a giant goal for this type of trade strategy, when and where to use it, which I'm calling prerequisites, and then how to select the options, both the leap and the short call, then revisit how to set the trade up, and then talk about managing the trade and especially management of the options. Now, we just went through a roll today, Fred and I did on some of these, so that's a subject that's near and dear and pertinent. So let's go into the first slide, if we could, please, Fred.
Sure. Justin.
Next slide. I'm sorry.
You're taking a bunch of notes there, but I think this is not like we'll send out a copy of this if you guys don't have it already.
Can you hear me?
Yeah, I got you.
Well, I'm actually writing down. You did a one on Disney today.
Yes.
So I'm writing that down so I can discuss it with you later if we get to it.
Absolutely. Go ahead, Mark.
Hold on a second, Fred. I got another participant who's trying to get in and has the wrong number. I'm sorry. My mistake. 800, what is it? Okay, I got it.
800-471-337.
Technology's great.
Okay, we got that taken care of. So the leap call diagonal trades are long-term trades with the potential to make significant profits through theta decay over many months. Now, as you know, when you sell an option, time is its enemy. It erodes the value of that, which is exactly what we want when we sell it, right? And we want it preferably to perhaps to expire out of the money or close to out of the money, and it really is less of an issue when you do the leap call diagonals. This is it's a lot like a credit spread, okay, but just on steroids. It can make you a whole lot more money. I'm sorry, not credit spread, debit spread. These are debit spreads. You will pay more for the leap than you are getting for the short call, but they benefit from price and calendar differences of the long leap and the short near-term options. And when we see a chart, you'll understand that probably a little bit more clearly visually. And these trades are intended to be nearly stress-free. And let me tell you, since Fred introduced me to this, I'm sleeping better, I worry less, I'm calm, serene. The market goes down 300 points. Oh, not a big deal. Okay, fine.
Sounds like
because we're. I'm sorry.
Sounds like a commercial for vitamins.
Yeah, Fred is my source of melatonin. Okay, let's put it that way. And these leaps are absolutely wonderful. But so these tend to be nearly stress-free so long as the bullish or bullish to neutral trend continues. Because remember, we've all been taught there are three ways you can make money with an option play, right? The market can go up, it can go down, or it can go sideways. And if we've got the right structure, two of those things will still get us paid. Now, with this particular leap call diagonal, since we're dealing with calls, we're expecting price to go up. So our risk is found in the declining price of the underlying security. Said a different way is, if it goes down, we can lose money. And that's the part you need to be aware of, but not worry about. Next slide, please. Questions? Anybody?
Okay.
Us, Justin.
I'll take that as a no. Okay. So these trades, as you can read, these trades are well worth the effort to learn them. They make us see the big pictures of movements. And I find that looking at these candidates very often on the weekly chart really gives me a picture of what it's doing on the long term, and it sort of blends nicely with the long-term focus of this trade. Our goal is to capture the theta decay of the short option while experiencing periodic price increases of the leap in a bullish to neutral trend. And you've probably seen me post in Slack like, oh, RTN repriced again today. Hooray. It's wonderful. You make a couple $100 just by doing nothing and just paying attention to the market. Like, oh, it went up today. Great. We limit risk by monitoring the price of the underlying security and being sensitive to earnings announcements and careful selection of when to enter. And we'll hit that a little bit more sensibly. But as we all know, buy low, sell high, right? So you're looking for a bounce off of significant support. That's the spoiler right there. Next slide, please. Questions? Comments?
Yeah, I have a question,
All right.
Mark. This is Dave.
Go ahead.
I'm not sure what you mean by a reprice, and how do you know that it repriced?
We'll come to that. I'll give you a visual example.
That's fine.
Okay. Not a problem, sir. Be happy to do that. So when I say for working with these, you really want to select a security that you know pretty well or can learn pretty well, right? And you want it to have a bullish or neutral trend. Initially, I got in one with a strong bullish trend, and that just reinforced everything I needed to see. It also led to a couple of repricings, and it made me very, very happy. But you want to look for price and moving averages bullish for at least the intermediate period, at least the last few months, okay, in my mind. Now, each of us has our own trading style, and you may find that your criteria differ from mine, and that's fine. As long as it works for you, terrific. But the key is you're looking for a recent bounce off of support, like a neckline of a double bottom, or a significant move of the average, like the 50, 100, or 200 especially, right? You really want that you want to look for the long-term trend. Again, looking at the weekly chart can help you identify where it has bounced before and what it did afterward. And of course, the last prerequisite is that the security has to have leaps available, and you really want some liquidity in its options. Hold on, let's pause there a second. I got a message here. All right. Let me send Darren the Zoom number. 800. What is it again? 800.
471.
371?
No, 4.
Oh, 471?
Yep.
337?
Yep.
All right. And every time I change screens, you see I lose that. So we'll give him that, and maybe he'll be able to join us. Okay. Thanks.
So Mark.
Appreciate it. Yes.
So backing up a slide to monitoring price of underlying security and sensitivity to earnings announcements.
Right.
If you're buying a January 2019 call, you've got like 8 earnings announcements or more between now and then.
Yes, absolutely. Good point.
Are you saying? Okay, go ahead.
No, my focus, it's a great question. My focus is really if it looks great today and it's just bounced off a major support and earnings are in 2 days, you might think real carefully about, do I want to get in now or do I want to see what earnings do? And you go back and you look and see what earnings have done the last 4 or 5 times. And if it gaps down every time, let's not get in right now. Let's wait for prices to settle out in the new environment. It's really what I'm trying to say there.
So you bought Disney January 2019. Do you plan on holding it that long? I mean, obviously it depends what the underlying does, but.
So are you referring to the latest trade?
Yeah, the latest one you guys just did today. Oh, that was you, Fred. Sorry.
I don't know if Mark did or not, but so there was 2 entries on Disney. I did one right before earnings, sensitive and aware of earnings that's coming up. So I got a very good implied volatility sell on the short side.
Right.
Leaps don't price themselves quite as erratically as with reflective of earnings. So I was okay with going and buying the leaps because they were priced appropriately. And Mark's going to show you how to price them appropriately. And that trade actually failed for me at break even because I bought in at 110 and change on the underlier. It popped up, I think, to 112 or something, and then it dropped down in the 108, 109 range. And that we're going to show you on the chart or on the risk analysis graph. I hit right at break even, and I went, boom, I'm out.
Gotcha.
And so that was, I think, Mark, 2 days ago or yesterday.
Yes,
Was that
I think
yesterday?
it was. Yeah.
And then today, obviously, what happened to the market? There was a bunch of gap downs, and Disney was right at a buy point, so I went in again.
Gotcha.
So 2 separate trades. One didn't work. Oh, well, it was break even. So what? And then the second entry based on, okay, we got all the excitement out of the way. I'm still bullish on Disney.
All right, so you don't really have any intention of holding it to January 2019.
Oh, yeah. No, if it's working, I will hold it all the way through
Okay,
those. It just depends on what the chart and what the market and the sentiment.
Right. So that's what I'm just trying to, when you say you're monitoring it along the way, at any time you're ready to pull the trigger if it's approaching break even or less.
Yeah, I'm not gonna fight the market. If
Yeah.
you know, we're in it to make money. So
When I hear the word leap, I'm thinking of you're buying something like 2 years out and then you're just holding it, that whole time or at least for a while.
you're holding it as long as it works.
Yeah. Okay. That's all right.
And then when you're done with it, get rid of it and find another setup.
Thank you.
A leap is nothing more than
Just a long call.
a cost-effective way instead of buying the shares.
Yeah.
All right. Any other questions on prerequisites or what we've covered so far?
So what you're ideally, Mark, you're making money on both things. You're making money so Disney, for example, is at 105. If that goes up, your long-term leap is going to reprice higher.
Yes.
And the one that you sold, Theta decay is eating away. So as long as Disney stays below 110, you can close that hopefully with a profit.
We'll deal with it. Don't worry too much about closing it, before it gets in the money and so forth. We've become pretty adept at dealing with that.
So Mark is going to explain, and we might even show an example of what you do in those cases.
Thanks. I'll be patient.
Absolutely. And thank you. Your questions are good. All right. So how do we select the leap? You look for the farthest out one because we're going to buy in wholesale. The other day, Fred and I were looking at a couple of leaps, and the January 18 version of the leap at the same strike as the January 19th differed in price by $1.
Cheap.
So, by taking the farthest one out, you're getting an extra year of life for $1. That's just a good deal. Yeah. So you want to go as far out as you can, right? All right. So you open the chain, you look for a delta of 70 to 80, and you're looking for some open interest. You might find one that's at 78 delta and it's got 0 interest. I wouldn't be the first one to do that, and that's just my personal swing on it. Look for it, even if it has 4 or 5 as the open interest. Great, that's better than 0.
That's
all right.
That's kind of Mark's technique. I don't really mind the 0 interest one, as long as it's a well-known stock. If it's something obscure, I might not touch it, but it depends on the underlier.
And then Fred and Mark, how big are the spreads on these?
Depends on the underlier. So,
right.
If you look at Apple or SPY or some PG, look at some of the other larger underliers. Their bid asks are very, very, very reasonable.
Yes. Again, the more popular ones are going to be closer together.
Yes, and you don't have to buy at ask, sell at bid because you can put in a limit order on it as well and see if it gets filled. So.
And I did that recently. I put it in under market, and it did fill about an hour later.
Right.
So we'll come to that. We'll do some examples of this, and you'll see pretty well how to do this. Now, this is where I'm going to ask you to visualize an option chain in your mind, and a fair price for the leap option will generally be between 20 and 30% of the underlying's current price. So, for example, in this case, I think our underlier is at $60.61.
Which one are you looking at? Here, I'm just going to pull up one so they can see it.
You got, okay, there we go. You got, okay, 306.11 on Tesla.
Okay.
And
Use that one.
we're,
That's fine. So let's go.
yeah,
to
we are currently, if we were, oh, that's the short. We need the leap.
Yep. Sorry.
There we go.
You need this one.
There.
Everybody see the gazillion numbers on the screen?
Yeah.
So, Mark, why don't you talk to him and I'll interactively point these out.
The price is $306.
Okay,
So
yeah, price is 306. And currently, if we were going to try and buy this today and recognize that it's probably already bounced off support, so our numbers are going to be a little bit skewed perhaps, right? But right now, you see we got a spread of $81 to $84. $1.50's the midpoint, so $82.50.
here's my mark price right here. This column is mark price.
Oh, that's right. You've already got it there. That's right. I do it the hard way, but you already have it calculated there. Sorry. $82.50 is the mark price, and the currently that is selling at 306.11. So if we divide that $82.50 by 306.1, we get a 26.95% ratio. That's right about in the heart of our 20 to 30% zone, isn't it?
Which leap were you looking at, Mark? Sorry. 260?
The 260, the one you're holding.
So this
See,
one,
the delta is
this one
between
right
70 and right.
73 delta.
So the delta's in the zone.
Mm-hmm. So take this mark price right here. Did you guys follow what Mark said to do? Okay, look at the mark price. It's $82.50. I'm going to write it out here in chalkboard style. $82.50. Okay. Divided by trade price. Can somebody get up a calculator and tell me what that number is?
26.95%.
Equals 26.
You get different.
95%. Okay. So,
That's what I got. All right.
okay. So I'm going to erase those numbers. Can you guys remember that? And let's look at Mark's slide here. Does what we just did there on Tesla fit what Mark just said?
Yes.
But did it have open interest?
I don't have an open interest column up on my thing, but on Tesla, I can probably pretty much guarantee you, yes, there's open interest.
I know of at least two because Fred and I are in it. So yeah, again, we chose a delta between 70 and 80. I think it was 73 on that particular option. There is some open interest, and 25 point, let's say 26 or 27 for round numbers falls in our 20 to 30% zone of the underlying current trading price. And that's in a snapshot, folks. Whenever you're looking at it is the number you use, okay? Whatever's showing up on the ladder at that particular moment. Now, the other day we came across one that was Procter & Gamble, in fact, and we were talking with someone who had retired from Procter & Gamble, and Fred says, well, let's take a look at that one. And the chart looked good. I mean, yeah, the chart of the underlying. And then he pulled up.
I think he's on the call.
Yeah,
I think
it was. I'm pretty.
So,
yeah.
Procter & Gamble.
But that person, that otherwise will remain nameless, but we didn't want to embarrass anybody. So anyway, yeah, Procter & Gamble. And we ended up choosing the 75, I believe that is, right?
Right there.
So at the moment it is. And
that's
the delta was good.
Yep.
Yeah, delta 74 is in the zone. And the mark price is at 13.1. So let's do the arithmetic. 13.1. And I'm going to divide that by the current trading price of 86.26. And my calculator says that's a 15.18, well, let's say 15.19%. That leap is on sale.
It definitely is. That leap is on sale. That is an excellent.
So do you want to
price.
buy something at 15 or at 30% off? You buy it for 15% instead of 20? Heck yeah.
Right there. That's why when we did this the other day, I placed the order online and I bought the contracts right while we were having the conversation. So, Mark, let's jump. While we have the class attention, I want to show you guys something, right? What was that price here? That Mark price is 13.1.
Yeah.
Yes.
So let's go back to the Junes right here. What strike was that? Was that the 80?
75?
Was that the 75? I don't remember.
On PG?
PG, 75. So I want to compare apples to apples real quick, guys. 70. Let's look at the $75 strikes on PG, which are right here. Okay. You guys agree in the front month, this is June. Okay. Front month is on sale, 75. What's the matter with my pricing? Why is it showing 1145? Because it's in the money. I can't believe it. This is
That's not the one you're holding, though, right?
yeah. No.
Oh, you're comparing this to the Leap?
I'm doing a comparison to the Leap. Okay, so what was the price on the
Okay,
Leap, guys?
sorry.
1310,
1310.
and this one's 1145.
Okay, is that Angela talking?
No, it's Kathy.
Kathy. Okay, sorry. There's two women on here, and I don't have voice recognition quite yet on you guys. But so, guys, how many months are in between right now and the January 2019 expiration? Count them.
18, 19, something like that.
20.
20.
Okay. I've already done them because you got to count all the way into January. There's and we got to count the May to June. So there's 7 months left in this year, plus one in the end, the January one way out there, plus 12 is 20. So this front month options pricing is $11.45. There's 20 of those in there to get all the way to that other pricing. What is that? What does this number multiply out to be? Let me do the math here. It's 2290.
229.
Yeah, 22900.
20.
$229, yes.
$229. There we go. What on earth is going on here, guys? I can buy a year and a half for $13.10. Was that the right price? $13.10? Somebody must have written it down.
Yes.
Yeah, it is because of the underlier price at $86.26. What is the? What if I divide those two numbers? Somebody's 229 divided by 1310. Tell me what that is. It's a giant.
17 and a half.
What is it?
17 and a half.
All right. So here's in essence what we're doing, guys. We're going out and buying a box of 20 contracts for $13.20. And then we're turning around and selling it at 17 times the premium that we paid. If you compare apples to apples, the $75 strike, our technique doesn't quite use a linear thing like that. We have a diagonal with different strike prices. But do you guys agree that that is an outstanding argument for wholesale pricing versus retail selling? I'm buying at 1310 and I'm selling. I'm sorry.
Okay. I see what you did.
Yeah.
So you're repricing the June of this year, paying it forward 20 months, and saying $11 for June now.
If you bought these every month, yes, for 20 months, you'd pay $229.
Yep.
But we're going out and paying $13.
Oh,
Is that we all as a group looked at the math right there and said, I can't believe that is happening. Why would a retail trader go out and buy this option right here? Anyone? It's open class. I mean, there's no right or wrong answer.
Hoping price goes up.
Hope the price goes up. They go in here and they buy this 75 out in June for that's $1,145.
Right.
Hope the price of Procter & Gamble goes up. But what do they have fighting against them?
Time.
They have this monster right here.
Time.
Time, right? They have 30 days to make that thing work, all right? We are the sellers of that premium. We can sit back and let the depreciation occur as long as the stock remains neutral to somewhat bullish. If it's explosively bullish, the deltas don't work out. And if we slide into neutral negative territory, then the leap, our wholesale pricing kind of loses. It's like buying a house. You don't want to go out and buy a house and have the price go down. You want to have the price of the house generally creep up, and you want to sell renters to it every single month. Well, that's what this is. This is your rent.
But hold on, since that is in the money.
Go ahead with your question.
I'm trying to figure out if when you sell a call that's in the money.
Are you selling that?
Whoop.
Selling that call?
Yeah.
Hang on. Before we go down the selling ITM,
Okay.
That's a price comparison that we just did.
Right.
Because I had to compare the $75 strikes.
Okay.
What we actually do is go down here to the ATM or ATM plus one pricing. Okay, somewhere down here in this zone. Okay. But I know that I paid such a tremendous discount for that strike out in the future. So you can't look at 13, because a lot of options traders will look at $13 and go, oh my gosh, that's $1,300. I don't want to buy that. I want to go back here and buy the cheaper one.
62 cents.
But the cheaper one is going to have a fight like for its life. It's like a fish pulled up on the dock. It's like flipping and flopping, trying to survive because Theta is killing it. So I think that's a good mindset to transition into Mark's next slide here. Let's take a look because we've determined how to show the leap. Now I think he's going to show you how to determine the front month.
Mic check.
Can you hear me? Somebody
Loud
said,
and clear.
okay.
Who
All
was
right.
that?
I don't know. Somebody said mic check.
Oh, it was Brandon. Sorry about that.
Okay, no problem. All right, Mark, on to the short call side.
Okay, so we're looking at the front month call if there are more than 10 days remaining in that call. Okay, else we're going to use the farther out option. So why would we cut it off at about the 10-day level?
Theta decreases faster.
What? I'm sorry, say again?
The theta decreases faster as you get
Yes,
closer.
indeed. That's exactly what happens. And you're not going to get paid as much for selling that one. Right?
Right. It's going to be a lesser premium.
Yes. And since we're in the business of selling retail, after buying in wholesale, we want to get as much money for that as we can conceivably get. So we're going to choose an at-the-money or an at-the-money plus one strike to provide good premium and to lower the total trade costs. Because remember, we're going to sell the shorts against that long that we paid for, $13. And so we're going to do this, we hope, many times, and we're going to try to bring in as much revenue as we can. So how do we know what a bid, since we're buying a bid, what's the fair price for the front month option? And generally, it's about 10% of the leap options premium. Remember, we said $13.10. So about 10% of that, we'd be looking at $1.30. Now, we'll say 10 is not a hard and fast number. 9 to 11 might work for you. If it's more than that,
Well, let's do the exercise, right? What's the closest?
Yeah.
What's the closest one of these strikes to 86 1/4? To 85, right? Look at the mark price.
All
Is
right.
that 10%
More.
of the other one.
More.
At least 10% of the other one. Yeah, you bet it is. You absolutely bet it is. It's $2. Like, you got to be kidding me. I will sell that to the market all day long because I have a whole box of these things over there for $13. I have 20 of them. You're darn right I'll sell that for $2. I only paid $13 for the other ones.
You can almost be wrong, like with this strategy, you can almost be wrong 90% of the time and still generate income.
You could be a little bit wrong and you can still actually generate a profit, which is not the same as what happens when you're wrong by buying a straight equity and it goes down in price. You lose. This one has room. It has room.
Hit it on the head. You can't escape the Theta decay monster.
The buyer of that, that's right. I think Brandon said that. The buyer of that option right there cannot escape certain death. Right. That thing will die on 16 June at close 2017. And that is what we're capitalizing on. All right, let's go to the next.
What about the obligation though?
The obligation because you've sold short.
And it's in the money.
The obligation only matters if the strike price that you sold the option is in the money at expiration.
Right.
So, well, I think
Right.
Mark is going to get to that. We have an example of a trade last week, I think it was, Mark, that I got assigned short shares because of a dividend. Mark's going to go over what to do there. And what I did on the trade. I actually made money, so I'm like, well, that works.
Yeah. Fred is quite the wizard at this, even though he doesn't like me to say that.
Oh, he's the man, for sure.
Absolutely. Any questions about the short call and how to select one? No? Okay. So anyway, how are we going to set the trade up? We're going to ensure that our fair pricing percentages are hit and make sure our theta, well, we'd like to get a theta ratio of about 1 to 3 leap to short. It doesn't always happen, but it's okay if you have, and if the leap theta value is 0, you count it as a 1. Okay. Just because my dividing by 0 is meaningless. All right. So anyway, we're going to assess all the other risks of the trade: earnings impact, the time of the year, merger activity. Some stocks are cyclical, right? They perform better sometimes of the year than others, and we can look at the weekly chart or the monthly chart, and we can pretty well pick out what those patterns are. So those are parts of the things that you'll want to consider when you're trying to do this. I know it's really tempting to look at the potential profits, but as we all know, getting a look at the real picture and seeing what's truly there is far better than what we'd like to think is there. We really want to see it clearly. Then we're going to analyze the trade. And I'm going to say this a couple of times. Trust your instinct. If the trade doesn't feel right, look at a short strike that's one step out of the money. And if that doesn't feel right, look at a different trade. There are plenty of buses out there for us to ride on. All we have to do is choose the one that's going to work for us. So don't feel like just because, the first glance at the numbers look good, that it's right. It's trust your gut. It saved me a couple of times. And then as far as overall risk management, you really don't want to put more than 10% of your account size on any one trade. You want to have, first of all, you want to be able to have a number of these if they're working for you. And 2, also enough capital to participate in a day trade or put spreads or whatever else that might work for you.
That is huge, guys. This number right here. 5% of your account value on any 5 to 10% max. All right. So that means that the cost basis of your trade entry not exceed that for any given particular spread. What you're doing is the same thing you're doing when you're day trading. You're position sizing. You're controlling risk via position sizing. This mistake is what I did when I learned how to do this strategy, because the strategy was working so well. I got greedy and started putting 50% of my account on, and you wake up one day $15,000 poorer, and you go, that sucks. 'Cause that's,
Are you talking about 10% of the margin that's being withheld?
no, if you have a no, not the margin. Do not add in your margin. Margin is a good thing to have as buying power, but do not risk more than what is capital risk dollars in your account.
And how would you select for instance, Jeremy has a designated R strategy for buying options, and more specifically stock. How would you apply that same strategy to spreads?
So a target R is what you're saying, I think.
Well, target is kind of more or less max profit, but for me anyway.
Your risk value. So your R is exactly the same it is in day trading. So if you want to risk $500, that R is exactly still the same amount. And you can use the risk analysis graph as soon as your trade. You can actually do a simulated trade before you do it, and you can tell exactly what what underlier price is at your break even, or you can just follow the line down and exactly make a mental note to yourself of where your stop loss at $500. The risk graph will tell you exactly where that $500 is going to occur.
So break even would be an R then, kind of.
Well, break even would be 0, right?
Well, right, but I guess that would be a 0. Okay.
Less than an R. With any luck, at worst, you're out only your commissions. Okay.
So,
but again,
we'll show you how to do that here. But the trade size, your position size should not be more than that right there, guys. Speaking from experience. This trade.
And again, if your instincts are a little bit uncertain, and you could buy 4 contracts and still be within that percentage, but you're really thinking maybe I'll just try one. I can always add to it later. That's a better way to play it. If again, trust your instincts, listen to your gut.
So I guess what Brandon's saying, if you have 50 grand and one contract is $1,300, you're not buying 20 contracts.
No, you're buying maybe 1 or 2.
1 or 2, yep, yeah. Exactly.
That's right. And that's plenty, guys. That is plenty, because options are so powerful that $1,300 is, ask Mark, you'd be surprised how much money you can turn out of that contract.
Let me give you a good example. Thanks, Fred. That's a great segue. I entered the Tesla trade on May 5th, start of the day, right before 9 o'clock, just before 9. And I bought 1 contract of each. As of today, I'm sitting at a 5.8% ROI 10 days later.
Even with the big gap down.
On 1 contract. Yes.
Absolutely, Justin. Today I made money and I was net long the position.
Well, 5% is good. You can do 10, 20%.
That's in 10 days. People struggle to do that in 6 months.
Right. And conversely, well, I'm getting ahead of myself. But yes, you can do it, and 1 contract can make you money. Don't think that it won't.
It makes you,
okay.
1 contract can make you, on the right trade, enough money to go buy your groceries for a month, or go, repair your car if the air conditioner breaks, or any number of them. One contract spread. These things are really, really powerful.
Right. Okay. So
I have a question.
Yes.
Yeah, I'm sorry. I have a question. When you guys say 1 trade, you mean the leap and the short, or just the leap and then the short?
It's the pair, Roberto.
Yes, the pair. All right, got it. Yeah.
Because they complement each other.
Okay.
They complement each other very strongly.
Okay.
Get selling without buying.
All right. You got the floor, Mark.
Now, this is my favorite slide, trade management. Read this with the sound of serenity, you know, gentle breeze blowing through the trees. This is so easy. Monitor your trades daily. And after the second day of the trade, or maybe I should say beginning the third day of the trade, if it's winning, be grateful and relax. If it's neutral, relax. It's still good. Remember, there are three potential outcomes in any market situation. And if we're winning on either one of those two, life is good, right? And if it's losing, exit your position near the end of the day. And I'm going to say that because how many times have we seen the market sell off in the morning and then go back and meet or exceed where it started the day by the end of the day? And if you got out in the morning and saw that your position went back to profitability by the end of the day, wouldn't you feel just a touch silly? Whereas if it's still losing at the end of the day and your instinct says, let's get out of this now, then you get out of it now with a clear conscience. Does that make sense?
Discipline.
All right. Also,
Yeah.
real quickly, watch the delta value of these trades because, you know, like Sink or Swim is what I'm familiar with, but it'll show you the combined delta. And sometimes it's pretty mind-boggling. You may look at it and see you got a 396 delta, which says if this price of this underlying goes up $1, I gain almost $400. Isn't that wonderful?
Yes, it is.
Yeah. And then you use your short option criteria for roll selection, and it'll maximize the premium paid to your account. You plan and roll your short option before expiry. Okay, before that expiration occurs. And why do we do it beforehand? Because we're going to take advantage of the theta decay a couple of days out. You know, there's not going to be a whole lot of money left in the short, and the price of the new one we're selling is still going to be relatively high because the herd hasn't started to run on them yet. And what happens when they start buying them? The price starts to erode, doesn't it?
Well, they artificially elevate that old option, and then they artificially suppress the new front month option. But
yeah.
And that falls into premium
So-
erosion rate is best between 45 and 17 days until expiration. On the
Right.
short.
Right. Even though I said don't do anything in the last 10 days, all right? Or I'm sorry, I'm about to say that. We'll come and explain this a little bit more clearly. Okay, so option management. Literally celebrate when your leap reprices, which may be one or more times per week, depending on what the underlying is.
so
Volatility in this case is our friend.
who was asking
All right,
about
theta ratio.
who was asking about leap repricing? What is that?
That was me, Dave.
So Dave, it means it appreciated in value. That you bought it at $13 and it now is $14, or it's now $15. That's a reprice because the leap does not move at the same fluidity that the underlier does. Even though, you know, your underlier might go up $2-3, that leap repricing will take a little bit, and that takes getting used to because people will say it hasn't done a thing and the short side is depreciating, and I go, hold on, cowboy, just, you know, wait for it.
That's exactly the point, isn't it?
And then when Mark saw that happen, I said, you know, Mark, just wait. And then it repriced Mark several hundred more dollars in your account, right? So
Yes.
you go,
Fred, can we look at an option chain real fast, like for Raytheon or one of those that we have that might have a reprice indicator on TOS? Because it's real easy to demonstrate there.
Do you hold the profit on the leap repricing, or do you take it and then reset up the trade?
that is the leap repricing is just unrealized gains.
I see one that went down today. Tesla went down today. Well, let's see what Raytheon did.
What did you want
I
to
got mine open a bit.
Raytheon repriced a little lower, but I'm not worried about it at all.
Yeah, we could show that. That'd be just as effective because I'm showing that the price went up for the day, but the spread went down.
The 130s. Well, what was your entry price on your leap, Mark?
Oh, well, originally it was 27,945
What's
on
the price?
April 10th.
Or what leap was it? 130s, right?
The 130, yes.
So the mark price after today's, rigmarole and dance with depreciation across the market, mark's still, what was it, 27 something?
29.
29.
$27.95. Yeah, $27.95. Almost $28. So I'm up over $4.
You're almost $4.50 in the money per contract, $450 per contract, and you've only had this trade on a month, right? Or less.
Right. 5 weeks. Yeah, 5 weeks.
And
such a deal.
Absolutely. Didn't you make money on the short buyback, or were you close to it? Was it
I made money on the short. I made money on the short buyback. Yes.
Yeah. So when we say leap repricing, this column right here, the mark pricing, moves. It just moves slower, guys. So if you place one of these trades, you just gotta wait. And if you see the underlier go up, it's not going to move at the same rate. But when it kicks in, it really kicks in. And you just wake up and you go, holy crap, there's $4,000 in my account, more than I went to bed with. So that's why you see us posting sometimes, hey, these leaps repriced. If you're in them, check out your account. You've got some money in there. And if you
close that out, if you're watching technical analysis, or
you just watch technical, the objective is to keep making money. So if it's going up, I'm gonna let it run, man.
Yeah, and you see like a shooting star, a doji or something.
Well, okay, yeah. I mean, different traders are different. So if you can take your money and run and then reset it up, or I'm way slower to move the position. I mean, the chart really has to show me that
because the big game is the short leg that you're after.
You're
right.
You're the two complement each other. They're holding hands, husband and wife. They fit together very, very well.
Spread, it seemed, or I'm sorry, with a bull put spread, it seems like you sacrificed the long leg.
Oh yeah, your gains are capped with a bull put spread. You're not capped in this game.
Now, and remember how we were looking at that option chain, and the numbers for the 360 today were red. You'll know when it reprices on if you use TOS or maybe some other platforms too, because it'll reprice both of those numbers will be green, and you go, hot damn.
Oh, I see.
More money in my account.
He's saying because I have a position marker here too on Raytheon, and it's a red number, so it repriced itself a little bit downward today with the downward action.
Oh, okay. Right.
But look up
and
here.
on my chart, my ladder, see, I have the net change column, and it showed me it went up 35 cents today, but both prices came down.
Maybe it did.
So I guess what
have
happened was maybe the mark price went up 35 cents because it tightened the range.
I bet it did, and probably due to a little bit of volatility kick.
Yeah.
All right, where are we?
About the short.
Yes.
If the short is in the money, you want to close those so that you're not obligated to. Let's see, you've sold a call, so you're obligated to buy, right?
That's.
I'm not.
Go ahead, Mark.
That's common concept, but that's not necessarily what we do.
No, I know that. So you want to get out of the short before it gets near expiration.
Before it expires.
Yes.
Yeah. Yes.
Which is this.
You don't want to hold it
on the maze.
So how does this work with your? How much capital does this take? Is there when you short those, when you sell those calls? And so you have to have all that money in your account, as if you were buying those shares.
No, because
Okay.
because you're
Your margin because of the leap, right? Because of the leap.
Yes.
Yeah.
Yeah, it's like a covered call.
Yeah, exactly. Okay.
So your equity or your trade capital available will be allocated by your broker because of the difference between your because they know you have the leap there.
Right. You bought $1,300. You bring in whatever $130, 10% at least, and that's all you have to. So you're just out $1,200.
Your net debit to cash then is $1,200.
$1,200 in that case.
Yes, because you'll receive 100 and something for the
right. Okay.
1,300. Your net debit to cash is $1,200.
All right. So because when you sell a put, you have to have all that money there.
You have to have a ratio of it. It depends on the broker, but
You're selling like a naked put, right?
Yeah.
Okay.
Yes, this is not naked trade. This is a covered trade.
Exactly.
we're not. That's right.
All right.
Yep.
So back to the middle bullet. Okay, be happy. Your shorts are decaying faster than your leaps because, and you'll see that the theta ratio will increase over time as the trade moves with the trend. You go, hot dog, this is working. And in the last 10 to 14 days of a short options life, leave it alone. And this is going to be challenging for some of us. Okay, profit does accelerate as theta decays, and yes, we'll roll it maybe 3 days before expiration, but resist the temptation, especially if it's in the money, to get out now, because you're making good money these last few days.
The most amount.
Does that make sense?
The most amount of theta decay is going to come in the last 10 to 14 days, and the most common error for the new trade style is you want to get rid of those things to get rid of those shorts. And I'm telling you, hang on to them.
Is 10 to 14 days not where you roll that over?
3 to 4 days.
3 to 4 days out, really?
Yeah, we rolled today.
Yeah,
I rolled one today and two yesterday, right?
I rolled Tesla
The
today.
only reason I ask.
And when did they expire?
Friday.
Okay.
And Tesla was in the money. I was not. I wasn't sweating it. I was like, well, whatever.
You can't be early exercise, right?
There's a, and that is a risk. So, but is it a large one? And after doing this for many, many, many years, it's really not that big of a risk. Your risk elevates if there's a dividend payable, because somebody wants to capture that dividend, and then if you are holding short shares, you're going to be responsible for that dividend.
Right.
But the standard options, week, exercising options, especially when they have theta decay remaining in them, is it's almost stupid, because I'm not saying the retail trader is stupid for doing that. I'm saying they didn't do the math, because if you exercise someone with theta decay remaining to capture a dividend, you just lost because of math. Because you lost the whole premium that you paid. The short seller now receives it all, and then he owes you back the dividend. But the net difference is the seller is still in a profit. He's going to show you an example where that happened to me on what was that, Mark? Was it Starbucks or LVS?
Yes, I believe it was. I think it was Bucks. Yeah.
Starbucks. Yeah.
All right. So let's move on to the next slide.
So yeah, just because it's a strike or two or three in the money, Mark, did I text you or say, what are we going to do with Tesla? Nope. I'm just like, wait.
No. All right. So here's the punchline of the album. If you pre-read the slides, you already know about this one, right? So here's an example of how the leap diagonal. That's actually backwards. It's leap call diagonal. I'm sorry, guys. There's a mistake on that chart. Trade makes us money. Bought Raytheon. I bought Raytheon, opened it on April 10th, as I said, and I bought to open the January C130 at 27.94.5. I sold the May 17 at 665, and I sold out of the money. Okay, based on an assumption, and I'll say more about that in a minute. So the net price per contract is $27.28. As you see on May 15th, when we computed the value of that, my option is now worth $33.67.5 per. My short option has grown to $1.255. But my net, when you do the arithmetic, the net price per contract is now $32.42 for a profit of $5.14 in 5 weeks.
Yep.
Pretty decent, huh?
It's $514 per contract spread.
Contract. Yeah.
And look, guys, This was an ITM option. He sold it at 66 cents and it lost. He was losing a little bit of money here. Whatever the difference between those two is, it's like 60 cents or something.
Right.
But look how much he gained here. If he lost, I don't know the exact math. Let's say he lost 66. How much did he make here?
$5. Over $5.
Over.
Almost $5, yeah.
Well, he made
Or
this.
is it over 5? I'm sorry.
He made that
5.7.
So this number
Yes.
is minus that number is $5.14.
Right.
I will do that all day long.
How far out of the money? Do you not get put or called that much when you sell that close to the money?
No, and that's really
Like, even if it's in the money, do you not get put or called that much? Because that's the one thing I'm having trouble wrapping around my head. Like, when you play that close to being at the money, I guess my understanding is skewed in that I don't have much understanding on the fact if you get called or put that much. If you're in the money at expiration, do you get called or put all the time or not that much? I mean, is it like a thing?
at expiration and you're in the money, you're going to get assigned.
Yep.
But we go about 3 or 4 days.
So you have to be, if you're playing that close in the money, you have to be somewhat directional on the trade.
Yes.
Okay. No, that's not.
That's about.
Oh,
But
Brandon, I think more than anything, you need to be aware. Okay, if you're in the money, you need to be aware, and you want to be out 2 to 3 days before, or 3 to 4 days before that thing expires.
Yes, sir. You are absolutely
Because
correct.
again,
but you
you're
don't
managing your risk.
want to get out 10 to 14 days prior because there's so much theta capture in those 7 days that you're going to shoot yourself in the foot. But the theta capture between, I mean, in those last 10 days of life of that contract is fantastic. And Mark saw the effect. And I'm like, Mark, don't touch it. Just wait. Trust, like Ben Kenobi telling Luke Skywalker, trust your feelings.
I love Star Wars.
Let go.
Right. And there's a mistake on this in this trade setup that I made, and it was based on a faulty assumption, but it just shows you that you can make a mistake and still do rather well. And I chose that May 160 based upon what was the projected move for that option at the time I bought it. And I bought an option that was outside the expected move. Excuse me, I didn't buy it. I sold it.
It was
Sold an option that was
+2, right?
was +2, yeah.
But it worked.
ATM +2. And I screwed up. And look what happened. I made money. I made a whole lot of money. 18.8% ROI. Yeah, baby.
In a month?
In 5 weeks, right? Just about 5 weeks, right?
If you messed up, does that mean you got called? So were you in the money at expiration?
No, I chose by the chart that I've given you, by the slides I've given you, my short call did not fall in the criteria.
Well,
And I still won as a result.
in the criteria that we are showing, but Mark's trade was still okay.
Right.
The stock behaved bullishly. His net delta favored delta. I had my only difference, guys. I had the same trade, except this number for me
150
was 155. Okay, and this number for me was like 240 or something. I don't remember the difference.
So you were out of the money. You were way out of the
It
money.
was ATM +1 at the buy. Or this for me was an ATM +1,
Oh, no, so
which
on
is
April-
one strike out of the money.
on April
And
10th.
I was 2 strikes out.
I'm not sure.
April 10th, I was 2 strikes out.
On the same date. But,
On April 10th, RTN closed at 151.
okay, and I actually legged into this one. So whatever the trade, I bought the 130s, waited a couple days, and then sold the 155s.
Were you waiting on volatility, or were you
I was waiting on a little bit of appreciation in the price to rise on up there, and it worked out.
Oh, so you could get more premium when you sold it.
Yeah, because remember I got $2 and something.
Yeah.
because the underlier had raised up closer to 250 or 155, so the premium went up as it got closer. It worked
You
out.
waited on the strike price to move or the stock price to move.
What's that?
You waited on the stock price to move.
The underlier. I waited for the underlier to move up.
Stock price. Yep.
Yep. And the January, the repricing hadn't really occurred, although I knew it was going to, and it did. And my trade worked out as well. So
How long does it take that repricing to occur?
what do you say, Mark? It depends on the action.
I'm sorry.
Depends on the action of the underlier, but sometimes it might take a day or 2 or 4. I don't know. It's
What, for repricing?
when the underlier moves up. When does it?
It can happen a couple times a week. It really depends. If there's a sudden jump in the price of the underlying, then that leap could reprice. And I think I had 2 occasions in the last week where it repriced within a day and a half.
Like an earnings gap or something.
Yeah, I mean, you just have to sit back. It's one of these. Just sit back and let it work for you. I mean, this is a sit back and chill trade, but it's
I know, that's why I love it.
but it's sit back and chill because you are acting as the wholesale buyer. You went out and bought a bunch of stock for your 7-Eleven store, and then you turn around and sell all that stuff to the general public at a massive marked up price. What do? You just sit and wait. You just wait for it.
I get it for sure. It's actually I love it.
So, Mark, here's the early assignment.
Yes.
I think we're.
So what happens if you do get caught in? And as Fred said, it happened to him. It does not happen often in his experience, but early assignment of your short calls is not to be feared. It's just a matter of doing the math and taking quick action. And remember, as you have obviously been hearing it hammered into you throughout the course of this presentation, you've made money through theta decay. Now, you compute the net impact by summing up the net credit from the short sale plus the assigned price minus the buy to close price and any dividend you may owe as a result of the short position, if it applies. And then you add to that the new short sale premium. If Providence is smiling on you and you've set this up well and things are going and the theta decay is what you want it to be, it may result in a new cash credit to your account. In other words, you can get out of this out from under the obligation and still make money.
So, Mark, what was
Is that a deal or what?
I don't remember the exact numbers here, but let's say this was $1.32 short sale, right? Plus my assigned price. I do remember the 58.50, right?
Can you give an example of this? I've never been able to understand words. I can only understand numbers.
What's that?
Just in the future sometime. If you put like this example into numbers.
Yeah. Oh, that's what I was gonna try and do right here real quick. So
Words don't make.
This is the first one. This is a net impact by summing net credit. That was my first short sale, a net credit. Plus my assigned price was 58.5. Okay. Minus, what's the next one? BTC price. And I remember these numbers because it was a moment of victory for me. Right. And I think this was, Mark, help me out. I don't remember what the last number here was, but it was like 275. I remember these two very clearly.
Yeah, it was something like that.
Somebody add these up for me here. Who's got a calculator?
$2.05.
It's a okay.
205.
That's a little higher than what I got, but it's purpose. The purpose is met. That is a positive what? I'm sorry, you said positive $2.05.
5 cents.
5 cents. Mm-hmm.
How on earth did I do that?
So Theta picked up the whole being called on the trade?
Because that's right. That buyer that I sold this to exercised early. I'm sorry, I forgot to put the dividend in here. It'd make a difference of a quarter, right?
Yeah, it's 25 cents, right?
I'd have to add a 25 cents here.
So
That would be $1.80.
Subtract it, yeah.
that's a minus, though, right?
I'm sorry,
It's a minus dividend.
minus,
Yeah,
it's minus.
buck
It-
80.
It makes
Right.
$1.80. How on earth did I get a walk away from that transaction with $1.80 more than when I started?
That's beautiful.
And Brandon, you said it. Because the buyer of this option exercised on me early, and I kept the whole premium up. As soon as I saw that, I was like, really? Oh,
So you
okay. So what happened, Brandon?
I can tell you exactly what happened.
They,
Not that it was him personally, but basically you sold an option to somebody and made enough theta decay to pay for and then some being put or called, and plus the dividend, and you still came out on top.
I still came out ahead. And for that transaction, let's just use the numbers. So that person gave me $1,300 because I had 10 contracts on this. Okay. And they said, ha ha, you got to pay me $250. And I said, okay, if you really want to do it that way, I mean, do any of you want to do it that way? I'll do that transaction. Give me $1,300 and I'll give you $250 back. And you can think that you outfoxed me, but that's what happened. And this number, guys, because there was 1,000 shares assigned short to me, so that number looks big, right? It was $58,500 in that sort of exchange, and then I lost $60,500 here, okay? But I gained back $2,750, and you go bing, 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 math. I did the math like that when I saw that happen. And Mark, remember I told you that morning, what did I do? I went for a walk before the market opened, and I was like, I just made money.
Just had to let that one settle in.
So that's why I say don't fear the short assignment. Just do the math, all right, if it happens. And then if you have to roll your option to the next month, do the math, okay? Because the theta decay has occurred in your favor. And I showed you the wholesale versus the retail price. That retail price is money coming into you. It's just not, it's not intuitive. It's not apparent to you.
This theta or price erosion, was this trade, sorry, I'm sure you probably explained it. Did this happen over the course of a month, you're saying, or a regular month option?
Yeah.
No shit. I'm sorry, I didn't mean to curse.
So yeah, it occurs very, very slowly at first, because the theta curve look, you know, if you were to go something like this with time kind of going that way and price, you know, going like this, profit, it kind of goes like this. It does this like level thing, sort of goes up, sort of goes up, sort of goes up. And then right there, you guys have seen me publish in the RLT room at 10 days prior. I go, guys, it's coming off the cliff, because it goes like this, whoop, boom. That's why I keep telling Mark, don't get rid of the gosh darn thing right there. Right? Wait until right there to get rid of it.
Around 10 days to
10 days is that marker right there, and about 3 to 4 days is that marker. You don't want to necessarily you've used up the theta, you know, the rate of decay right there. You've captured most of what you need to, and then you jump to the next month and you do the same thing over. I mean, lather, rinse, repeat. That's all we did today on Tesla. So here, guys, look on Tesla. I have the 260 strike calls, right? That I paid $73 and I think it was 72 cents for. All right. 1312 was my May sale at 305. This is a 305 strike call, right? What did Tesla do this past month? You guys followed it. It went whoop, whoop. It did this crazy bounce, and what did it do today? It closed like 306 or something. And Mark, where did I roll? I rolled it right at 309. And
Yeah.
what happened? What was my price on the roll? I sold it 13.12.
I think it was like $8. I mean, $18.
I sold at 13.12, right? That's a plus number because you receive a net credit.
Right.
I bought it back
And-
for $6. I think it was like $6.50 or something.
Yeah.
What's the math? It's not quite 7, something like that. I think I made about $7 on it.
Yeah, it's like 762 or something like that. 662.
Okay, let's just call it that. That's not quite the exact numbers, but it's close enough. There's profit. And then what did I do immediately in the same transaction?
Sold the call.
I turned around and sold June. I sold June 305 at $14.30. I said, hey, my shelves in 7-Eleven are getting low. I better put some more supply in there. I just turned around and pulled, because I have this giant box of contracts on Tesla. You think I'm going to sell at $14.30? Heck yeah, I'm going to sell that thing at $14.30 per contract. So that money, that $6 and whatever it was right here, was all theta decay in the month.
Right, but what if
Absolutely amplifies the profit curve.
Tesla can jump to like 330 though in a week?
And it did. It went up there.
So what happened to you?
Mark, let's look at I have let's look at Starbucks.
Absolutely. Yeah, Tesla is volatile and can jump like that. And as Fred said, when the market opened this morning, our calls were in the money, and he was patient enough to wait till about 9 o'clock, and it rolled down, so those were out of the money, and he got good money.
Well,
he managed to buy that back. Okay, near at the money, but I mean, he was able to buy it back for less than I did.
What did you say? Somebody else had a question. Let's look at the analyze risk graph here. Okay. This is my actual position on Starbucks, which I've shared with a couple other traders, so I don't mind sharing the numbers with you guys here. All right. So Starbucks has a 10 contract spread entered in down here. This is my June short at $60. This is my Jan 19 at $50. There's only $10 between those strikes. It's kind of a very shallow diagonal.
Yeah, that looks weird, man.
So what is all this, guys? Anybody want to answer that? I know, Mark, you can. I know Mark knows what it is. What is all that?
Profit.
That's money.
Good at.
Yeah, that's what I've made on Starbucks. Look at the line. I go across here, and I'm sitting at $2,200 in about, I don't know, 6 or 8 weeks on one single trade. I'm just doing this in my sleep. This one trade, and I didn't do anything. And this up here, somebody else tell me what that is.
Potential money.
Potential profit.
Potential money. This is June money. Potential, yeah, because I mean, if the stock rockets down here, and I'm going to lose, right? So this is present day profit. That is acquired. It's there. This is June theta decay that's sitting there. So the peak of my trade goes from here to here. Notice the $60 strike is the peak of that triangle, and it goes up in 1 month, guys, from $2,200 or $2,300, whatever that profit is, to that's about $3,400. on that graph. If it closes at that strike. And I didn't do anything. You think I can go buy some groceries with $900? Yeah. Yeah.
How many days out did you put this on?
This is roughly 30 days out.
Okay.
This represents about 30 days.
So you say you put it on 30 days ago, or 30 days from June 17th.
This trade was Starbucks was the one we did last week, so it would have been 35 days. Remember, because I had to do that little scramble action roll thing because of the short assignment.
Okay.
This number down here is accurate. That's my net cost basis, and this profit is accurate with those other transactions rolled into that thing.
Quick question I've been wanting to throw in here. What's the, I don't know how the right way to put it, cost basis? How much margin does this strategy soak up opposed to a regular like bull put spread or?
It's the same it's the same thing.
Can hear you.
Look at your strikes.
Well, with this one, yeah, this looks like some of the bull put spreads I put on. But
So the broker sees that the same way. They're like, well, there's $10 of
Yes.
risk in there minus premium received, so there's your margin. It's not very much margin required to put on this trade.
yeah, that's something I got to learn. I feel like, I don't know. It seems like a lot of my margin gets soaked up somehow. I'm really not sure why.
Yeah. Let me share one other thing with you guys here. This is the break-even price here. Okay, so if Starbucks goes down in price, right about there, roughly 55, that's my break-even price. And remember, let's say I was risking $1,000 on this trade. I'm just throwing that out as a number. I know that right there, that underlier price of 53.75 is my exit price. Does that make sense?
Yeah. Oh, yeah.
Do you guys see how I did that? This is very important in understanding how the curves work and how to read the graph so that I can still make a legitimate decision on when to get in or when to get out.
That actually answers my question perfectly. You just kind of, for your R value, you just pretty much when you're receiving credit, you just kind of put out there what you're willing to lose and then just exit.
That's right. Yeah. If this goes wrong. Now where's my risk up here?
No risk, all money.
Where the lines cross?
Nada.
64.
Making dollars.
Your risk, remember what I've published in the RLT room. Your risk is to the downside.
Yeah.
Okay. This line will intersect the zero line, but so far out there, I mean, up at like $90 or something. This is declining. This represents a little bit of declining profits as the delta values. Like if this stock rockets up to the moon, you get capped a little bit on your gains. That's why this is a neutral to slightly bullish, not a neutral to gigantically bullish trade setup.
Because you're so far out of the money that your delta goes down to zero.
No, your delta goes to, well, if it goes up, you mean?
Right. Oh, yeah.
No, the deltas even out.
And it also
You
goes
get a 1.0 on your long and you get a negative 1.0 on your short, and they equal out, and you eventually cross the zero line.
because your gamma turns to almost nothing also.
Yeah, the gamma will drop out of there. Let's see. Let me turn that off. Let me go around and ask if you guys have any other questions. It's a lot of information on how to price the options and how to manage the trade. It is definitely harder to learn than straight option or a bull put spread. Bull put spread, you do this, stock goes like this. Okay, I made money. Or if it goes the other way, I capped my losses and I understood what I lost. This one's a little more non-linear. It relies on the holding hands of your delta appreciation augmented by theta depreciation on the short front left side.
So on this trade right here that you have on Starbucks, you have positive delta.
That's right. Yes. And how can you tell that?
Right here under delta. And then where's your theta?
It's just not displayed there.
Yeah, it's not displayed. Okay.
So the sum of those numbers is what? 734 minus 467.
300.
Oh, 300.
Little.
So every dollar that Starbucks goes up in price, this trade makes $300. And the short side, just like what happened today, guys, is a gigantic shock absorber. Okay? I can allow, look how wide I can allow this stock to move and make, make some money. It could go way over here and I'm still, look at the range, 57, 66. Do you think I'm worried about the day-to-day motions on this thing when I see that line going up? Not at all. Not at all.
Are you in the Disney trade?
Yeah, the Disney one. What did you want to look at on Disney?
No, I just wanted to see it because you guys just did it, so I want to see it priced.
Oh, the pricing on Disney. So charts. Disney. So check out this thing I drew like a month ago or something. And then I just happened to see Disney gap down again. By the way, remember I said we entered here and got out. I was able to tolerate this candle here because the shorts helped me out. But then I was like, that's when I hit my break even. I was like, okay, I'm done. Let's see what else happens. And lo and behold, magic happened. And today, my target container was down here at the 38.2 retracement line, right at Jeremy Newsom support right there, right? And there was the target candle. So that was the technical analysis of that particular trade. Hang on, I got to get rid of those. The options board.
So what's that gray box? Is that?
That was my target box. That was me just inserting a target box.
So that's where you want to buy and.
That was my buy. That was my buy zone. Yep. And it's right here. I haven't moved it, guys. That was put on about a month ago because I was estimating somewhere in this range, and it occurred about 1 day earlier than when I drew the box.
So you bought January 2018, 92.5 calls.
Yeah, let's go back here and look. Right here, the position marker, right? Mark price.
Okay. So that's Starbucks.
Oh, whoops. Thank you. I was like, wow, that's a pretty small. I must have got a real steal on that one. All right. So there's the Jans. Right.
So remind me why that strike again?
This number right here.
Oh, okay.
71.
By delta. Remember the rule is
gotcha. Between 70 and 80.
2.8. Mark has been leaning, I think, on some of yours a little more in the middle. I don't mind the middle one. I just happen to kind of and see that price right there. And you go to the mark price, $19.32. What is the relationship of $19.32 to the price of the underlier?
18.18.
106, 30. Sound like a familiar number, right? 18 something.
18.18.
Does that fit the rule?
Forget the rule.
If it's the rule is 20 to 30%.
Okay.
Yep, it fits the rule. And I do this on every single trade because you will see these skewed and you go, I don't know what's wrong with it. I'm not going to do it.
Do you buy the long leg at the strike price that you make your calculation on?
Yes, that is my long leg. I bought the 92.5s. That's the number that I published, I think, was I bought the 92.5s.
And that's what you use for the calculation?
Yes. Well, you can use somewhere in this range between the 0.7 and the 0.8, as long as it falls in that 20 to 30%.
Why is that better? Like, opposed to being like 1 or 2 out, you're like 4 or 5 out.
I say that. So if I understand your question, you're saying why?
Why opposed to, or why do you buy like 5 strikes out of line?
Because I'm looking for delta. I'm buying delta.
You're buying at 3/4 delta.
Yeah, that's about the aim point.
Okay.
You might read John Carter's book there, and he does the same technique. He says, yeah. Oh,
so, John Carter.
John Carter, Mastering the Trade. In that book, he recommends the 0.7s as well, and I'm like, yep. We'll figure.
There.
John Carter.
What was or is that the author?
Angela is taking off. See you later, Angela.
Yes.
Bye, Angela.
Bye. Have to feed a family.
Okay.
Okay.
Carter runs the simpler trading websites with all of its sub branches. He's done this for about 27 years. I think he's been trading.
You have the name of the book?
Mastering the Trade.
Mastering the Trade.
So sorry, we had a what was the price of the other one? 18. No, it wasn't 18. It was already lost track of what.
Sorry about that.
I lost track.
You sold the 110 call.
No, what was the price of the 18 Jan one?
19.325.
Yeah. Okay. Thank you. And so we go back here and look at the money one. Okay. So at the money at 106, boom, boom. Here, oh, that's May's. I'm like, that price.
You did June, right?
Yeah. I was like, ooh, that price is wrong. Did I make a mistake? No, I just am in the wrong month. So the 106s are pretty close to these 105s. Is 2.7 to at least 10% of the other price. What was it? Justin,
what
was the price of the leaps? Sorry.
19.325.
Mm-hmm. So is this price then at least 10% of that?
Yeah.
Yep.
Like 15, 16%?
Yep. And it's because it's about $1 off.
On Slack, you wrote 110s, but you actually did 105s? Or
no, I'm determined. Yes, I did 110s, but what I'm saying is you can tell the fair pricing by looking at the ATM. Does that make sense?
Yeah.
You leave at 3/4.
So I'm sorry, what was the question, Brandon?
No, so you do the leaps at 3/4 delta.
Yes.
Wherever the strike price lays, and then you do the front month.
I do a pricing analysis back on the front month to make sure that the ATM is.
Oh, right.
And then because I know that one is fair, I can go this way or this way, which I wouldn't go that way because that would be a net delta negative. So I want to go this way. So I went to the 110s. That was about ATM plus a little bit more, call it ATM plus 1. And I know that that's a fair mark price because the one above it was a fair mark price as well.
Right, but so if you ran into something that was like, say, 4%, then that would be something you would stay away from?
Well, yeah, I wonder why it was at 4%. Is it?
You want a higher percentage so that you get.
So I get paid more. Yeah.
Yeah, more unfair pricing. You get paid more. Exactly right.
Yeah, I'm not going to sell my box of options for 4%. I want 10, 12, 15%. I want to mark it up, man. Right?
What percentage do you leave it alone, or is it stock by stock or underlier by?
Less than 10. But if it's less than 10, I'd wonder why it's less than 10. Are we inside of 30 days? Are we at 2-week window? What's going on? Because there might be some theta decay that is occurring.
Well, you're looking at your expiration on the front month.
Yeah, you're looking at your expiration on the front month as well.
Why didn't you sell the 105s?
That was just a so the rule, if you go back to the slides, is ATM or ATM plus 1. Okay, so the 105s would have been a very net, would be more neutral-ish, and the 110s would be a little bit more bullish.
Oh,
So that's just calculation, Justin. That's just how you figure out if it's fair priced or not.
right.
And as option sellers, we want unfair pricing.
So what? Yeah, and he was saying, why did I sell the 110s? That was just me going. I think that stock is going to be a little bit more bullish than the 105s would allow.
Because of your technical analysis at the
check. Yes, exactly. Because of where it is on the bounce point on the
chart.
On the chart back here, right? So based on that, I said, okay, I'm going to go up here and sell the 110s up here. Now, on the previous trade that I broke even on, and Mark, I think you remember this trade, it was a 95. It was a 95 110.
Yes.
So it was right there that I did it.
Wait, do you sell puts and calls accordingly with this strategy?
What's that?
You sell puts and calls accordingly with this strategy?
If you're going to sell puts, you're adding to your delta. So, I mean, unless you're really sure the stock is really bullish, then no. But you can reverse the strategy.
Yeah, but are you not directional, being in the money or at the money with your?
The one augmenting technique I will use to this trade is I will sell a bull put spread to complement. So if this starts to, rocket up here and I go, oh, yep, it was true, I'm going to go, mark a BPS right here and because I'm net adding to my delta and I want to capture more delta upwards movement of that stock. That's all I'm doing when I sell a BPS right there.
I got you. So you're double teaming it.
Yeah, you're making it longer than it was.
That is awesome. I was thinking
again, another Carter technique.
Yep, he does. He mentions the same thing in the book. So you can augment the trade.
Go quadruple long if you want.
And I did that on a previous Tesla trade. I had augmented, and I went, "Oh, that was easy."
So wait. So you already sold the call.
Yeah.
And then, so to make the bull put spread, what did you then do?
Well, I haven't done that on this trade yet, but if I were to, so right now, our trade setup is a 92.5, a call right there, and it was a 110.
Yeah.
And I have a short call right there. So I'm drawing, a long call because I want it to move up, and a short call because it will stay there. But if this stock, starts ripping up, why not go in? Why not go in here and sell a BPS?
Gotcha.
Right.
Why
not? Make more money.
Do you play with volatility much or no?
These are excellent for volatility because you'll get good pricing.
Oh, for sure.
Sale on them.
Bother looking at it for your strategy.
But
Can you hear me?
For this strategy, I should say.
You got to be careful with it because volatility is the monster that it is. So if you're gonna do that, you're kind of sticking your hand in that animal cage of what's going to do. I did it. See this earnings play right here? I think that was the day before earnings or whatever I did right there. And earnings kind of did this. I did kind of stick my hand in the cage, and I got my hand back out of the cage before it bit me.
Yeah, see, I've been doing that actually. Like, to be honest, I've been collecting, anywhere between 40 to 90% premium over these earnings months, and I'm like, I don't like this feeling. Like I just want to kind of get away from that and just go back on some good old Theta decay because
Yeah.
I'm trying to get
This-
away from the emotional aspect. You know, it's almost like buying options. You know what I mean?
Fred, can you hear me?
I hear somebody. Yeah, who was talking?
Ken. You posted something the other day about buying the last half hour of the day or first thing in the morning is because of volatility or something?
It helps to kind of wait on, it's, you know, like Jeremy has his, I'm going to wait some amount of time. For me, if you're going to kind of look at it, I wouldn't enter the trade. Like I wouldn't enter this style of trade in the first 30 minutes. The market is just like a swimming pool of sharks, man. Right? Like all the, every day trader in the entire globe is just feeding frenzy.
Because this guy is in West Coast.
So I do this after all that volatility is over, and the last half hour of the day is fine. For the rolls, I think was what you might be mentioning. So Tuesday afternoon after 3:30 p.m. to sometime on Wednesday, preferably Wednesday morning. Today it might have worked out better to wait till Wednesday afternoon, but oh well, whatever. You'll capture the maximum amount of theta. Your new resale of the new front month will benefit the most if you wait until exactly that time. I've done this many months over and over and over, and the math works out. So it is a verified technique to wait until that time.
How many days out is that? Are you talking about Fridays?
Yeah, so Friday's expiration, Tuesday after very near to market close, within the last half hour of the market. So you're talking what, 3 days plus 30 minutes.
Okay. Yeah, that's what I was referring to.
Yep, and that's why I do that, because well, it's because of math, but the price collapse of Theta has occurred. Most of it has occurred, and then I'm going to resell. The reason I want to resell the next front month right there is because most retail traders that know how to trade options, and most institutions that are allowed to sell your trade options are only allowed to do covered calls, and so they're going to do their covered calls on Thursdays and Fridays, and I want to beat them, because what happens, guys, when a commodity has sell pressure? The price goes down. So I want to beat the institutional call selling, because they're going to depress it on Thursday and Friday. I want to be up here so that I naturally gain more theta than they did. It's a very refined technique, and all I'm doing is getting in the front of the line. I want mine first.
Hey, quick question, comment. In your travels and people that you've spoken with, as far as you know, we have bots now and high frequency trading. What ratio or how much of an aspect does that make on our trading style as options sellers? Are the bots taking advantage of that strategy?
I don't find that to be the case at all. I mean, if you look at this here on Disney, I mean, this is human nature, right? There's a bottom, there's some activity, there's this, there's this. This is all humans. This is all humans causing that to happen. I mean, there might be some bots in there, you know, pennies or something like that along the way, but this is a very human-based signature.
Yeah, it is. No, you're absolutely correct. Thank you for that explanation. No, I see it. You're absolutely right.
Well, guys, I got to wrap it up here, go spend some time with the family. It's 7 o'clock here on the West Coast, and I hope you guys got something valuable out of it.
Yeah.
It's a lot of material, all right? And I think if you guys have what Mark sent you, take a little while to digest it. Try, and this gets really exciting when you do it with real money, because you start seeing the effect and you go, and believe me, guys, I've had it happen. Guys are like, that Fred Atwater is full of crap. Right? Because they see the fluctuations, and I try to gently coach them. Just wait for it. Let's wait, guys, because you've been briefed that the thing is going to outrun it. And as long as the underlier, because back over on the graph, right, the analyze, I have shown you your risk is to the downside. Anything the stock does between here and here, well, dude, okay, don't get too excited about it. The graph shows you, and I think Mark was grateful for me showing him the graph. When you get excited, you're like, dude, just pull up your analyze graph and go, oh, it's just moving around. It's moving around with human behavior. It's normal. It's natural. And it really allows me a lot of flexibility.
Oh, most definitely. I mean, it's by far the king strategy for sure.
Yeah, I mean, and I don't really do that much for it. I just
you're taking advantage of the delta, you know, as well as the theta with this strategy, and that's just genius.
All right, guys. Well, Mark is very versed in this technique as well, so feel free to, you know, ask away to him. And if he has any, you know, questions, I'm glad to answer as well if I'm available. And really, this is all free in the nature of RLT. I mean, I probably paid about $10,000 to learn how to do this stuff, and a lot of practice. And like I told Mark, it's easy when you're under the guidance of a veteran trader at it. Like, so if you have questions and you do it, and you can bounce the concerns off of me, great. It's when you step out on your own and start that the real challenge is on. Because when I stepped away from my mentor, I still stay in contact, not because we're not friends or anything like that. Man, I started making some errors, and I asked him, what am I doing? And he's like, yeah, what are you doing? You're not doing what I showed you how to do. So, it's not the market's fault. It's a mistake is typically my own fault if I do it.
Paying tuition into the markets. Any professional trader, I'm sure of it.
Yep. So anyway, guys, thanks a lot for calling in. This was my first kind of hosting of this size of a group. I've done this one-on-one with many people, but having an interactive group of folks to talk to and to do it. It's a learning experience for me too, because I get to go, ooh, did I explain that properly? Or did fellas get it? Did they, make some benefit from it? So I'm in a learning curve too. And I've shared a lot of things with Mark about, I don't quite know how to do this on Thinkorswim, but I'm going to figure it out. And I've had a huge learning curve over the last couple months as well. So I will see you guys probably in the AM there on the active channel. If you have questions, let me know. And if you guys become proficient at this, let me know, because I'd love to share with you techniques of how to teach people. And it's funny because I've taught so many people how to do it. I know exactly what they're going to ask. Like Justin had a few questions earlier, and I'm like, yep, there it is. I knew someone was going to ask that. I knew someone was going to ask about what if you get assigned, or what if, because of practice and doing this. So I do learn a lot, and I do very much enjoy it. So.
And that was huge, actually. So you get assigned or put, and you're still money ahead. Like, I was so afraid of being assigned, and now I'm not.
Well, in that case, it worked out. But had it not worked out, what if I'd lost, $500 or something? I would have just resold the next front month for more premium and gone, okay, consider it an expense. Whatever.
Yeah, exactly. Just like that hot water heater.
Yeah, which, by the way, got replaced today. It just took me a phone call and a check, and it was.
Yeah, exactly. That's how you do it.
So, and guess what? The tenant is going to send me a rent check on June 1st, and
they already paid for it.
Yeah, they've already paid me for it. They just don't know it yet. So, it's the same. It's the same with the retail trader. When you're selling them this box of contracts one at a time, once a month, they've already paid for them, what they've done, because I've gone out and bought it wholesale. You just have to really wrap your mind around that concept. It's a different style of trading, to be sure. It's not buy right here, sell right here, 15 minutes later, and I made $300 or, whatever.
I think it's the concept, actually, because I studied this same information over and over and over in different areas. And it finally just clicked one day like a light bulb, like ding, there it is.
Yep.
That's just what has to happen. Yep. Everyone just needs to research theta decay. If somehow you were confused in all this, theta decay is what you need to research. That's what you need to understand the problem.
Yep.
Hey,
right.
Our friend.
Yep. Go ahead, Mark. I got to close up here. My kid just poked his head in.
All right, guys.
Thanks, guys.
Thanks, everyone.
Thank you.
Thanks, Mark. Thanks, everybody.
Good night now.
Good night.